This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, joining Kriti and me now is Harry Colvin, Director and Senior Market Strategist at Longview Economics. Harry, thanks so much for joining. It might be a little bit more calm this morning, but I'll tell you, the UK two-year yield yesterday was really remarkable. We're back above 5%. We've got CPI, we've got a BOE decision this week. How worried are you about the UK?
Well, we're pretty worried. We're in the midst of a generational interest rate shock, not just in the UK, but in the US and, of course, across Europe as well. And it's going to cause a lot of pain, particularly in the housing market. And if you think about the way we run our economy, sadly, we've got one of the worst economic growth models in the West, in the UK. We rely on rising house prices, asset prices generally, strong positive wealth effects, and then more appetite for consuming and, in particular, borrowing. It's a terrible way to run your economy, but that's how we do it. So when money tightens up, we have problems, particularly in housing with the consumer.
So Bloomberg Economics has this piece out basically saying if we go to 6% from the BOE in terms of rates, we're going to get a recession. It's going to bring GDP in by about 2%. Does the BOE need to err on the side of caution? Again, just given that transmission mechanism we were talking about with mortgage rates.
Absolutely. They've over-tightened policy. So has the Fed, so has the ECB, and they set the stage for recession because all of these central banks have what we call Volcker religion. They'll do anything to fully purge inflation from the system. They're paranoid about repeating the Arthur Burns years of the 1970s where they didn't squeeze inflation properly. And so recession, in their mind, is a price worth paying to kill inflation off.
Well, Harry, walk us through then the story of how that translates to the rest of the world. You're seeing this kind of extremely hawkish action in the BOE. You're seeing it in the Bank of Canada, the RBA, and certainly around the world to lean hawkish. To what extent is that going to kind of influence the Federal Reserve that is kind of the contrarian right now, talking about pausing?
Well, they skipped, didn't they? But let's not forget it was a hawkish skip, and there were two more 25 basis points hikes in the dot plot. So they want to keep going. They want to keep money super tight. We've got an inverted yield curve. We've got very tight credit conditions. And importantly, we've got a turn in the credit cycle. And therefore, we're going to increasingly see a turn in the economic cycle. So I think the stage is set for recession in the US, probably beginning later this year, if not early next year.
Well, isn't that recession then kind of priced into the market? Then talk to us about the translation into kind of the longer term thinking from the Federal Reserve as we're talking about not cutting rates for perhaps years. At least that's the phrasing from Chairman Powell. What may have them change that view?
Well, firstly, it's not priced into markets. We had the low in the equity market in the US in October. And if you look through the history of recessions, there have been 15 recessions since and including the 1929 to 31 depression. And in almost all of those, the equity market bottomed either during the recession or after it had finished. So if you want to believe we've priced it in, you have to believe that that was all done in October last year, potentially a year before the recession even started. And I'd say as well, it's not priced into the rates market, certainly not priced into the credit market. We've got high yield credit spreads trading at around 500 bips. Really, we want to see them at about 1,000 to feel like the credit market's priced recession. So that's, I think, a unique opportunity for asset allocators today, that we've got a recession coming, but it's not properly priced.
Yeah, even triple C's. I mean, the junkiest of junk bonds had a rally last week. What does the default cycle then look like in your mind?
Well, it's potentially a large one because we've got a lot of zombie companies in the US. We think there are about 10% of the listed corporate sector that are zombies. These are companies that have been unable to cover their interest expense with their EBIT for 3 consecutive years. And they're going to be struggling in higher rates. So that's the risk if you want to create a really bearish scenario. But probably it's going to be a relatively mild recession. And I say that because the US is structurally much stronger than it was, say, 10 years ago.
I mean, look, I'm still kind of getting over the fact you're saying that everyone has over-tightened. Basically, all the central banks have over-tightened. So what do we do from here? I mean, is it too late then when it comes to central bank policy? Do they need to start cutting?
I think it's too late and they can start cutting, but I doubt it's going to make a lot of difference, which is always the case as you go into recession. They start cutting, but the recession dynamics have already started to emerge and unfold. The dominoes have started to fall and the dynamic is at play. And then it takes a whole cutting cycle usually to properly stimulate the economy and cause it to reaccelerate. So I think all the tightening's in the pipeline, it's too late. And what we do is we move underweight equities and overweight bonds.
Well, Harry, then talk to us then about kind of the issuance or the deluge of issuance that we're expected to get over the next weeks and months from the Treasury. There is a question in these credit markets about just how digestible that is. Is that something that you're worried about when it comes to these credit conditions?
Absolutely. I mean, I think you've got to remember one of the key reasons we've had a very strong rally in risk assets, particularly in tech, is because we've had all this liquidity as the Treasury's been drawing down its balance, the TGA. This is its balance with the Fed. So, look, it's going to have to rebuild all of that, and it does it by issuance. We're going to get about $1.3 trillion of net new issuance by year end, and that's going to suck liquidity from markets. So, this is a really key reason to be bearish on equities and other risk assets over coming months.
But Harry, isn't the market already dealing with a liquidity story? We've been talking about these kind of credit liquidity for, I want to say, at least a year and a half before even the banking turmoil came about and before the Federal Reserve was way farther into its rate tightening cycle as it is now. Why is this liquidity warning different than the others?
Well, the liquidity warning I'm really talking about is the Treasury sucking liquidity out of financial markets. That's what I'm referring to, and that's a big problem. I think perhaps the liquidity you're talking about is the signs that we're seeing junk bonds failing. We're seeing some failures at the margin. We've had a little mini banking crisis, particularly given the outlook for the credit cycle and just how tight credit conditions are in the banking system.
Harry, I feel like after this conversation, I need to go into my portfolio and make some changes. Yeah. Harry, I'm afraid that's all we have time for. Thank you so much for joining Harry Colvin there, Director and Senior Market Strategist at Longview Economics. Now, coming up, we're going to take a look at some of the market-moving events you need to be watching out for this week. This is Bloomberg.